Today we are going to talk about making decisions when the randomness is present, is evident. And you have to act, and you have to act under uncertainty. That's what executives get paid for. That's why we are in that chair. I was a CFO of a company that had to make a big decision. We had a new product launch that had been in market for 3 months. And early beta results, they were looking promising. Revenue was 20% expected above projections. The question was, do we double down now? Do we invest another $2 million in marketing and then hire a dedicated sales team? Or do we just wait and play safe and see? And the head of product said, well, the data is clear. We are beating projections. Let's go. What are we waiting for? And then the question becomes, is 3 months enough data? We should be seeing random variation that is creeping in. We might invest $2 million and discover the product is actually average. So he pushed back. If we wait 6 more months and the product is a hit, we have lost 6 months of growth to competitors. We cannot wait forever, Hindal. Guess what? He was right. And I was right, but that's a dilemma. In business, you rarely have the luxury of waiting until randomness resolves itself, that it will provide you all of the answers. You have to decide with incomplete, noisy data. And the question isn't how to eliminate uncertainty, it is how to make good decisions despite it. I'm Hindal. Today I want to talk about how to make smart decisions when you know that randomness is present. And that is the key, making those smart decisions. And you know when randomness is present. I can't repeat this sentence too many times. It's such an important sentence. Let me start off with an uncomfortable truth, the reality of business decisions. Most business decisions are made with insufficient data. In the last video, I said you need at least 36 data points to start seeing patterns and often hundreds for smaller effects. You remember that? But in real life, you frequently have to decide with 5 data points or 10 or maybe not much at all. A new product launch, you have 0 historical data for that product. A new market entry, you might not have any data. You just need some basic market research and you're guessing based on adjacent information. A key hire, you have a few interviews and some references, that's all. Waiting for statistical certainty sounds nice in theory, but in practice, the world does not wait. The competitors move, the markets shift, and the opportunities they close. So the question is not whether to decide under uncertainty. The question is whether you will be able to decide under uncertainty. And the question is how to do it well, how to navigate it well. And here is the mindset shift I want you to make. Stop thinking about decisions as right or wrong. Start thinking about them as bets. Every decision in reality is a bet on an uncertain future. Some bets pay off, some don't. Your job is not always to be right. That is impossible when randomness is involved. Your job is to make bets where the odds are in your favor and where you can survive being wrong. And that is a fundamentally different way of thinking. And it is a right way when randomness is real. The other part of it, I've talked a little bit about expected value thinking. Let me introduce a framework that has transformed how to make decisions, and it's called expected value. So what is expected value? It's simply an average outcome if you made the same decision many times over. It accounts for both how much you could gain or lose and how likely the outcomes are going to be. So here's the simple math, nothing too deep. Say you're deciding whether to invest $100,000 in a marketing campaign, okay? If the campaign succeeds, you make $500,000. And you estimate that to have a 40% probability. Now, if the campaign fails, you just lost your $100,000 investment. That could be a 60% probability. So what's the expected value? So the expected value is the 40% times the 500K plus the 60% times the 100K, which is about $140,000. So with this math, the expected value is positive. On average, this bet will make you money. Even though you're more likely to fail than succeed, the upside when you win is big enough to make it worthwhile. And that is the key insight. You can make good decisions even when the most likely outcome is bad, as long as the payoffs are skewed in your favor. Now let me be clear, expected value doesn't tell you what will happen. You might lose that $100,000. And that is an issue of uncertainty. But over many decisions like this, you will see that you're coming out ahead. And here's the flip side. Sometimes a decision might look appealing, but it has a negative expected value. Say there's a 90% chance of making $50,000 and a 10% chance of losing $1 million. So that would be 0.90 times 50K plus 0.10 times a million. So now you have an expected value of $55,000. Even though you'll probably win, the catastrophic downside makes this a bad bet. The expected value is negative. This is why I always ask the two questions. What are the probabilities and what are the payouts? And both matter. Sizing the bets based on uncertainty. And here's where it gets very practical. When you know that randomness is present, then you have to size your bets accordingly, right? The more uncertain you are, the smaller your initial bet should be. You're buying information at that point, you're not going all in. Let me go to that product decision that I opened with some time ago. Three months of data, 20% above projections. Is it signal? Is it noise? We're not sure. So what do? We didn't invest a full $2 million. We invested $500,000. Enough to accelerate meaningfully, but not so much that we'd be crippled if the product was average. We said, okay, let's run this for another 3 months and we will invest in this product, but not at the full. And if results stay strong, we'll double down on it. We'll invest more. And if they fade, we have learned something valuable at a reasonable cost. You see what I did? I changed the entire shape of the decision making. And that's how you handle uncertainty. You don't bet everything on noisy data. You bet enough to learn and then you adjust. And this principle, it applies everywhere. It applies in hiring. Not sure if someone is great, start with a contractor or a consultant role before making them full-time. If you're looking at new markets, not sure if there's demand, run a small pilot before opening an office. Product features, not sure if users want it, build a minimum version and test before building the full thing. Pricing changes are important to be considered as well. Not sure how customers will react, test with a segment before rolling out company-wide. In each case, you're limiting the downside while you're preserving the upside. That's all. And if you're wrong, you lose a little. If you're right, you can scale up. And that is a technical term for this. And it's also called option value. You are buying the option. You are buying the option to do more later once you have better information. That option is valuable. Now consider the fact of reversible and irreversible decisions. Here's another framework I use constantly. Is this decision reversible or irreversible? Reversible decisions can be undone relatively easily. You can course correct if you're wrong. However, irreversible decisions, they are permanent and can be very, very costly to reverse. And once you're in, you're committed. So when a decision is reversible, you can afford to move fast and accept more uncertainty. If you're wrong, you can adjust. The cost of being wrong is low. However, when a decision is irreversible, you need to be much more careful, gather more data, think harder about the risks, because the cost of being wrong is extremely high. And so let me give you some examples. Reversible. Running a marketing campaign, if it doesn't work, you stop it. You have lost some money, but you can redirect. For an example of an irreversible mistake, signing a 5-year lease on a building. If your needs are changing, you are stuck paying for space that you don't need. Reversible would be hiring a contractor for a project. If they are not working out, you can end the engagement. Irreversible, acquiring another company. Integration is complex. You cannot easily undo it if the fit is wrong. Another example of a reversible decision, testing a new pricing tier with some customers. You can adjust based on their response. That's easy to do. But irreversible would be cutting prices across the board, and it's very hard to raise prices later once customers expect a lower price. So in other words, when randomness what randomness does, it kind of makes me uncertain, and I ask if I'm wrong, can I fix it? If yes, I lean toward action, move fast, learn, adjust. If no, I lean toward caution, gather more data, reduce the bet size, and build in exit options. This doesn't mean avoiding irreversible decisions. No, I'm not saying that. Sometimes they're necessary, but I make them much more carefully with more analysis and ideally with more data. So here's something critical that you need to be aware of. Decisions are not one-time events. They are part of a continuous process of learning and updating. You make a decision based on what you know today. Then new data comes in, you update your view, you adjust your decisions. And that is Bayesian thinking. You start with a belief, you observe the evidence, and update your belief based on that most recent set of evidence. So let me make it practical. Going back to that product investment, let's say, after the first $500,000, we watched the results very carefully. And in month 4, it looks strong, but my confidence increased. Why? Because more months have transpired. In month 5, there was a slight dip. Was the initial strength random after all? My confidence decreased a little bit at that point. Then again in month 6, it was strong again. Even better than month 3, my confidence increased again. You see, going up and down is very sawtooth emotions here. And after 6 months, the pattern was clearer. Results were consistently above the projection. I was now confident enough to invest the remaining $1.5 million. So notice what happened. I didn't decide once and I just forgot all about it. I made a smaller decision first, observed what happened, updated my beliefs, and then made the next decision. And this is how you navigate uncertainty. You learn as you go. You do not wait for perfect information, but you also don't ignore new information when it arrives. So build this into your processes, set the milestones where you review the results and ask the question, what have we learned? How should that change our confidence? And what should we do differently? Every piece of data helps separate signal from noise. Use it. The other component that you need to think about is building robustness in randomness. And what do I mean by that? It's more of a higher level idea where you build systems that are robust to randomness. Instead of trying to predict perfectly, design your business to perform okay across a range of outcomes. So, what do? You diversify. Don't depend on one product, one customer, one market, one supplier. If any one bet loses due to randomness, the others keep you stable. Number 2 is maintain the reserves. Keep enough cash that a random bad quarter does not sink you. Buffer against volatility. Number 3 is to build the flexibility. Avoid locking yourself into rigid commitments. Variable costs are more forgiving than fixed costs when demand is fluctuating randomly. Important component is to create those fast feedback loops. The sooner you know something isn't working, the sooner you can adjust. Rapid learning, it beats slow production. When you are robust to randomness, you don't need to predict perfectly. You can survive being wrong, and that gives you the freedom to make bets and learn. So yeah, that's how I think about it. So let me wrap it up very, very simply with 3 key things to remember from this session. Number 1, always think in expected value and not certainty, because you're always making decisions under uncertainty. Every decision is a bet. Ask what the probabilities are and what the payoffs are. Make the bets where the expected value is positive, even if you might lose any individual bet. That's number 1. Number 2, size your bets based on uncertainty. When you're unsure, bet small. Buy information before committing fully. Treat the reversible decisions differently than irreversible ones. Move fast when you can easily course correct, but move carefully when you can't. And finally, on number 3, update as you learn. Remember the Bayesian thinking. Decisions are not one-time events. Observe results, update your beliefs, adjust your actions, and every new data point helps separate signal from noise. So use it. Use it to your advantage. Randomness is part of business. You cannot eliminate it, but with the right frameworks, expected value, proper bet sizing, continuous learning, you can make good decisions anyway. It might not be perfect. It might not always be right, but they are good decisions nonetheless. And they might lead in the long run to better outcomes. So thank you for watching this session on randomness, and I hope to see you soon. I hope you have been enjoying these sessions. Take care. Bye-bye.